Here's the problem. We all want the money we save for retirement to last as long as we do and provide us with as much income as possible, right? But the money we save in our company pension or profit sharing plan, our 401k, 403b, or IRA, is simply not the best way to grow and protect our retirement savings or provide retirement income for the rest of our lives without the risk of running out of money. Why? Because there are three economic factors that reduce the value of a 401k, IRA, or pension plan, and consequently reduce our retirement income by at least 40%, and probably much more. Those three factors are taxes, inflation, and investment losses. Let's begin with taxes. According to the Internal Revenue Code, the money we deposit into a pension plan, 401k, or IRA, and the growth on that money is only tax deferred. That money is not tax exempt. So all of that money is still taxable, which will reduce our net spendable income during retirement by as much as 30 to 40%. Now let's consider inflation. According to the U.S. Consumer Price Index, over the 20-year period from 1990 to 2010, inflation averaged almost 3% each year, and the U.S. dollar lost 40% of its value. So if we had retired in 1990 with a monthly income of $5,000, it would only buy $3,000 of goods and services in 2010. And if the next 20 years are like the past 20 years, we will need 40% more income than we do today, simply to afford the higher cost of groceries, utilities, health care, auto repair, and home maintenance, as well as a retirement lifestyle that would include travel, vacations, dining out, and recreational activities. And the third economic factor affecting our retirement security? Investment losses. Because most of us have our retirement savings invested in stock market mutual funds. But according to the S&P 500 stock index, stock market growth has always been highly volatile. In fact, during the last decade, the 10-year period from 2000 to 2010, the S&P 500 index increased in 6 of those years and decreased in 4. But the net result was a loss of 9%, or 9 cents on every dollar invested. However, had you been able to avoid those 4 years of losses, your compound annual growth rate would have been better than 8%, and your money would have more than doubled over that same period. So a $100,000 investment in the S&P 500 from January 1st of 2000 to January 1st of 2010 would have been reduced to $91,000 with those 4 years of market losses, but would have grown to $233,000 without those 4 years of market losses. And it's not just the money we lose, but the time we lose as well. For example, if the stock market loses 40% of its value, as it did in 2008, we would need to earn more than 10% in each of the next 5 years, net of any fees or expenses, just to recover our losses and get even again. So how can we keep from losing any of our retirement savings and avoid taxation on our retirement income, as well as the growth on our savings, while protecting the value of our money against the effects of inflation? With a retirement insurance contract. A retirement insurance contract is structured in compliance with Internal Revenue Code Sections 72E and 7702, which allow us to earn interest on our savings without taxation and also receive income on our savings without taxation. But a retirement insurance contract also comes with a guarantee to grow our money every year without any losses ever, even when the stock market crashes or real estate values depreciate, giving us contractually guaranteed compound annual growth for as long as we live. What's more, with a retirement insurance contract, we can also receive annual dividends, and our dividends can be added to our guaranteed growth rate for additional growth on our savings. And although these dividends are not guaranteed, many of these contracts have paid dividends every year for more than 100 years, even during periods of depression and recession. Of course, a retirement insurance contract won't give you the potential for big investment returns, but you won't lose any of your money. You won't pay tax on your money, and you won't have investment expenses or management fees deducted from your savings. However, it will give you an average compound rate of return that is guaranteed to increase every year and enable you to earn annual dividends as well. And here's the best part. When it comes time to draw income, the tax code allows us to borrow the money against our savings instead of from our savings and without taxation for as long as we live. Because these tax-free loans are automatically paid off when the contract terminates at the end of our life. What's more, these loans can be scheduled to increase so that our retirement income can also keep pace with inflation. But unlike a 401k, IRA, or pension plan, a retirement insurance contract has no contribution limits, so you can put in as much as you want. You can also take it out at any age without a tax penalty, and the income you receive through the contract does not contribute to the taxation of your Social Security benefits. What's more, all of these contractual provisions are guaranteed by what's known as legal reserve insurance corporations, which are regulated by state insurance commissions that require these corporations to maintain capital reserves equal to all of their contractual guarantees. So you're probably thinking, this all sounds too good to be true, and wondering why you haven't heard about these contracts before. Well, it is all true. In fact, the tax code provisions and the contractual guarantees have been available for more than 50 years. But you probably haven't heard about retirement insurance contracts because most financial advisors, including bankers, accountants, and investment advisors, even many insurance professionals, don't really know much about them or understand how they work. Because retirement insurance contracts are a type of life insurance, and we've all been told that life insurance is a bad investment. But life insurance is not an investment at all. It is insurance. Insurance that protects our savings and our income from taxes, inflation, and investment risk for as long as we live. And after all, isn't that what we want? So ask yourself this. Does any other retirement savings plan offer tax-free income? Does any other plan offer the upside potential for market gains without any downside risk of market losses? And does any other plan offer progressively higher income to offset the rate of inflation? No? Then submit the form at the end of this video to learn how much tax-free income you can get with a retirement insurance contract.